going on, guys? It's Christian from Stock Hours. Today's video, we're going to talk about things that you should pay attention to when you're trading earnings or trading around earnings time. Um, so when you're trading during earnings, one of the first things that you're going to want to know, especially if you're a scalper, is the days leading up to earnings that specific week. So let's say Tesla, if they have earnings on Wednesday, aftermarket, then Monday, Tuesday, and Wednesday, the price of contracts is going to be way higher than normal. So if let's say you're playing right at the money and contracts are normally, let's see what they're actually trading at now. I guess it moved overnight, but where do we close at? Let's come to close that about 240, let's just say. So all right, let's say at the money contracts are trading around $350 on a normal week. Let's say there's earnings this week. These contracts might be priced in at $1,000, for example, or maybe even more than that. So with that, you have to know that let's say your normal position size is $1,000, so you would buy 3 contracts on a normal week, versus on an earnings week you could only really afford 1 to have your position size. Those contracts aren't going to move in a percentage wise the same amount as they would on a normal week. So if you're used to catching, just for example, 10% for a $1 move, on earnings week you might only catch 3%, just because contracts are inflated in value so much that when the stock moves $1, there's not that much premium relative to what the contract cost is. So one of the things you want to kind of keep in mind is that the percentage you make or lose on a given trade before earnings is usually going to be a significant amount less than what it would normally be. So with that, you can consider sizing up. I usually don't do that. What I do, I just stay away until earnings happens. This way I can just trade it normally. I don't have to think about what my sizing is or whatever. And then I could kind of get a good understanding of what contracts should do when I'm taking a trade. Because let's say contracts cost 3-4 times the amount and you're making dollar amount the same per contract, it's just going to mess with your head seeing that you're up 3% when normally you're up 10 to 12% on a given move of the stock. So you want to just make sure, if you are trading before earnings that week, that you just trade the same way you normally would. Don't look at your P&L, just focus on the charts, focus on what you're normally focused on, and just not trading your P&L, because you might get greedy in a way and then not trade what the chart is telling you, and that can cause you to just take an unnecessary red trade. So that's one of the things to kind of know before earnings happens, is just that contracts usually are inflated in price and you're not going to get the same percentage on whatever move that you're looking for. Another thing that you're going to want to focus on, especially right after earnings happens, is going to be the IV crush. So what that is the implied volatility going down after earnings. So this usually happens the first couple minutes of the market right after earnings happens. So let's say Tesla has earnings Wednesday night. So Thursday morning, the first couple of minutes, implied volatility is going to be trending down, just because the big earnings news happen. So when the market opens, there's not going to be a huge move that's being priced in anymore. We've basically already made the move that big money and most market participants are looking for. So on Thinkorswim, the way I find the implied volatility, you just click on the option expiration date you're looking for, and then on the top right, this little 55%, that is basically what I'm looking for. This plus or minus 7.4 is basically plus or minus the dollar amount that Tesla is implied to close at by the time these contracts expire. So the way that this is priced right now, Tesla is expected to close within $7.50 on each side. So that would be 247 and then 233. So somewhere in this range, basically. So somewhere within there and basically there. This is what Tesla is implied to close within. Just so you guys have a basic understanding of what implied volatility is. But now let's say when you have earnings, this implied volatility is going to be much higher than it normally is. So for example, or I guess leading up to those earnings is going to be a lot higher. So let's say Tesla has earnings Wednesday again, whatever. Monday, Tuesday, Wednesday, this might be at 130%, just for example. And then now Thursday, when the market opens, it's going to open at that 130%, but it's going to be trending down, and the most aggressive drop in implied volatility is going to be right off open. So let's say the first 5 minutes, it might drop, 10-20%. So from 130 to 110, for example. And then let's say the next 15 minutes drops another 10%. So now from 110 to 100. And then throughout the course of the day, it gets closer to reality. But the most aggressive drop off is going to be right off open those first couple of minutes. So what I recommend is to usually wait a couple minutes for the market to settle, for implied volatility to come down. Because when you're in a trade, whether you're in calls or puts, this implied volatility is priced into the contracts. So when implied volatility is higher, contracts cost more. And then when implied volatility is lower, contracts cost less. So when you get into a trade and then implied volatility is high and then it starts trending down, your contracts are going to lose that value. So the stock could move in your favor. If it's moving very slowly but implied volatility is aggressively dropping, then you're going to be right on your position, even if the stock is moving in your direction. So if you're in calls and the stock is slowly moving up, let's say over the course of 15 minutes it moves up $1, but implied volatility drops 30%, you're probably still going to be down on your position because that is probably playing more of a factor than what the actual stock is doing. So that's something to definitely keep in mind. That's why I always recommend on earnings plays to wait a couple minutes for the more aggressive drop in implied volatility to happen so you're not caught in it. And then when it starts slowing down, then you can consider taking your trade. But then even with that, you really don't want to be holding for that long. So like an hour-long trade, you're going to lose a lot of value in implied volatility. So the stock could be flat and you can still be red on your position. So that's definitely something to keep in mind, is the implied volatility crush. Now the next thing, it's more of a technical thing. The stock that has earnings is just going to have overall more volatility because there's a lot more market participants getting in or out of positions just based off of the news that was reported during earnings. So let's say right after earnings, you can get either a lot of profit taking, a lot of dip buying, a lot of aggressive moves basically. It could just be hype from the earnings. Let's say a stock had really good earnings. You can just get crazy aggressive moves. So that's going to be something to keep in mind. If you hit your stop loss, the move could be way more aggressive than normal. So you're going to really have to make sure you're respecting your stops, just because it can fly way past your stop and never come back. So that's something to keep in mind. Another thing, just from overall volatility, there's just bigger moves within the stock. So let's say the stock moved up $10. There's really no guarantee it's gonna stop there. So let's say, uh, just for example, let's say the average true range of Tesla per day is $10, and then you see that Tesla right after earnings, it made a $10 move. So you're expecting, it has to stop after that. Since it's earnings, it's usually a one-off scenario to where that average true range isn't really respected as much. Like you can have way bigger moves just due to the earnings news. It's really looked at as basically any news. It can just break a lot of technicals. So you think, okay, the stock is extended. Not necessarily, because the momentum and the hype from the earnings just makes it to where a lot of people are FOMOing in or really anything like that. So just know that stocks can get way more volatile than normal after earnings or even before it sometimes. Another thing that happens a lot with earnings is that stocks don't necessarily follow the market. It is important to always be watching the market when you're in a trade, especially as a scalper. You want to, see that the market is either helping or making your trade, harder. But when earnings happens, there's a lot of times where the stock just does its own thing. The market could be flat. Your stock could be, shooting through the roof. It's all basically driven through the hype of the earnings and basically what was said. So if big money is looking to buy due to whatever was reported during earnings, they're not going to really care what the market's doing. They just want to get their position in. So they're going to make the big move happen basically right away at the best price. Because if they're intending that this is going to go up another $100, then they're going to want to get in here. So that's going to be something to keep in mind, is that stocks basically are not necessarily going to follow the market. They can tend to break that rule and do their own thing, but it is still important to watch what the market's doing. And another thing is that earnings could affect an entire sector. So for example, Nvidia and AMD, they're both semiconductor stocks. They do basically the same thing. They have a very similar business model. If Nvidia reports super good earnings, there's a good chance AMD is going to move up with it. So, if you're looking to trade a different stock within the same sector, there's a good chance that the news hype is going to be driven throughout the entire sector, and to basically see what setup works best for you. But that's just another little tip to kind of look at, is how different stocks within the sector are moving based off of one's stock's earnings. And one of the last things that I'm going to want to touch on, but is very important, especially for swing traders, is kind of goes back to the implied volatility thing I was talking about, where you have this implied move. Right here is $7.46. So what I showed you before, so this was 47 and then 33. So let's just say, for example, Tesla had earnings today, and then it opened up, here. Even though the stock went up, your position is going to be net down, because the implied move is way higher than the move that actually happened. So some people think, the stock can just because earnings, you can have a huge move. If you don't have that huge move, then you're going to be red. So we can open up here and you can still be red on your position, because the implied move didn't happen. So there's going to be a lot of decay in contracts due to that alone. Another thing that people try to do is they'll say, let me buy 250 calls, which is around there, and then 230 puts. Use this as a straddle. One of these is going to go down 100%. The other one's going to go up 1,000%. So something like that, for example. If we open within this range, there's a good chance, or it's a super high chance, that both of your contracts are going to be down significantly because, like I told you before, let's say these contracts come back to normal price, so about 350, versus if they close the day before at 1,000. Both of these contracts are going to be down a significant amount if we open within this implied volatility range. So for you to really get paid on a swing, you have to break this range. I'll just draw a box so it's easier to see. For you to make money on a swing, on an earnings swing, you're gonna have to break this range pretty aggressively for it to really be worth it, to be honest. Since Tesla has been basically consolidating for a while, I'll show you the 1 hour. Since it's been a couple of weeks, to be honest, that it's been consolidating, the implied move is very small. That's why it looks like it can easily break out of it any given day, especially with, if it had earnings or something like that. But imagine this implied move was double or triple or quadruple, so let's say $30 for example. Then obviously you'd be dealing with a much bigger range. So instead of this, you might be dealing with like something like this. So that's just something to keep in mind, is that if you open within the implied volatility range, the range that's basically priced in to contracts already, if you don't at least break that move, then you're not really going to get paid. And then if you straddle, which is basically hold calls and puts into earnings, both of those positions are going to be down. So if you really do want to do that, you have to be willing to lose both sides, because obviously when you're swinging, it's harder to manage your risk. It's not like scalping to where you can get out at 5 to 10%, because obviously it happens overnight. So you're only going to be able to sell when contracts open the next day. But that's pretty much what I look for in earnings. I'll just go over the list again. IV crush is what happens right after. So first couple minutes of the market, I chill out. I kind of let it do its thing, let implied volatility come down, so that when I get into a trade, it's closer to flat, so I'm not getting decay on my contracts. The next thing that I keep in mind is that the stock can be very volatile. So there could be huge moves throughout the day. It's just something to keep in mind, to definitely respect your stop losses, and then knowing that it can move much more than average within the day. Another thing is that the stock moves on its own a lot of the times. So since there's earnings, that's basically like big news, big reason for money to flow in or out of the stock. So it's not necessarily dependent on what the overall market is doing. It's dependent on how people feel about the earnings call. Another important thing is the price of contracts. So before earnings, contracts are going to be way more than normal. So I personally usually stay away from it before earnings, and then I'll wait for the earnings release to happen, wait a couple minutes for implied volatility to settle, and then I'll be back to trading it for the rest of the week. And then after that, usually it's in a newer range, so those trades usually set up a little bit better. And the very last thing is with swing trading, to just be careful, kind of know the risks of swing trading earnings, and that the stock could move the direction you intended and you can still not get paid. So those are basically all the things that you should keep in mind when you're trading or looking to trade around earnings. But if you guys have any questions about that, definitely leave it in the comments below. If you like this style of video, leave a like, definitely subscribe, and that's it for me. Peace.
Yeah, hit that like button, subscribe, comment down below whatever things you want to see on this channel. I'll see you guys on the next video. Peace.